In this video, we're going to look at Bloomin Brands, and they own Outback Steakhouse and other large restaurant chains. What I do in my videos is I run an Excel model that I created to figure out the actual value of the company, the actual stock price. And I also look at the financial ratios and compare them to their competitors. So let's get started with the model. First, we need the market cap, which is $890.6 million. We also need their stock price, which is $10.18. That's what they're trading at. We need their free cash flows. And this is cash flows from operations minus capital expenditures. And this is how you value a company. You estimate the future free cash flows and discount those numbers back to today's values. And that's exactly what I'm doing in the video here. Next, we're going to get the net income, which is the profit and loss on the income statement. And we also need the revenue for the business, which is also on the income statement. And I'm really curious how companies like this are going to perform during coronavirus if their financials are going to get a lot worse. So next time they report their 10K, I'm going to do another video to see what the intrinsic stock price is. And I have a feeling it's going to be a lot lower. So the financials look pretty good. All the numbers are pretty consistent and positive. The revenue is pretty steady. It hasn't really been growing too much. It's actually been declining slightly. So that's not the best sign. Let's look at that capital structure because we need to know what discount rate to apply to the future cash flows. So the interest they pay on their debt is $49 million. And let's see how much debt they have. And debt is really important to look at because that's how companies go bankrupt, when they can't pay the interest on their debt payments. So if a company has no debt, they can never go bankrupt. But companies need funding. So the interest they pay on the debt is 4.7%, but interest is tax deductible. Let's get their effective tax rate. We'll go back to the income statement, and we'll get the income before tax. And let's take the 2017 number. That looks like the best one. Because some years they pay less in taxes than others because the income statement uses accrual accounting. So it's looking back into prior years. So the effective tax rate is 13.5%. So the cost of debt is 4%. Let's figure out the cost of equity. We need the beta for that. That's the volatility of a stock. The higher the beta, the more volatile the stock is. 1.79, that's not too volatile. It's not so great either. That means the stock moves about 1.8 times the market. Now let's go back to the balance sheet and get their current assets. These are assets that can be liquidated into cash within 12 months. And they include cash, accounts receivables, and inventory. And that's $340 million. Let's get their current liabilities. And these are payables and debts which are due within 12 months. And that's $962 million. And the equity, that's total assets minus total liabilities, or the book value. We also need their EBIT, earnings before interest and taxes. On the income statement, they call that operating income. That's how much money the company makes from its operational business, but before it pays taxes and before it pays interest. So let's figure out the weighted average cost of capital. It's a blend of cost of debt and cost of equity. Cost of debt is 4.1% and the weight of debt is 86%. That's a pretty heavy weight. The cost of equity is 16%, and we figure that out using the capital asset pricing model. The weight of equity is 14%. So the weighted average cost of capital is 5.74%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows, and we're able to estimate that based off of the prior financial information. We also estimated a terminal value, which is all years past year 4, and we discounted those numbers back to today using the weighted average cost of capital, and we get an intrinsic value for the entire company of $844 million. We divide that by 87 million shares outstanding, and we get an intrinsic stock price of $9.65. It's trading at $10.18, so it's trading at a 6% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company. They value at $11.76. So they're saying it's a buy. They're actually saying it's worth more than they're currently trading at. So we're a little different in our models. Let's see where the stock has been trading at the past few years. So it looks like it was really tight range for good 4 or 5 years, not really moving too much, but then it's dropped like a rock when coronavirus hit. It's come up a little bit, but not too much. It's hovering around the $10 or $11 area. They have a great PE of 6.8, and with the lower stock price, that's a reason they have a great looking PE, plus all that debt they're taking out. And that's much better than the average in the market of 28 and the median of 16. Really low price of sales also. That's price of a stock over sales per share. That means investors are willing to pay 20 cents for $1 of sales, so they're getting a good return in that respect. Price to book is decent, 5.2. That's price of stock over book value per share. Really bad current ratio, 0.4. They can't even cover half their current liabilities, which means they need to go into more debt. I smell a lot of difficulties with this company. This might be a possible bankruptcy in the next 6 to 12 months, but we gotta wait and see how their revenue is in the next financial reporting. Really great ROE of 77%. Probably because they have a really low equity taking on so much debt. So it does make this ratio appear a lot better. They have a 4.1 interest coverage ratio, so they cover their interest payment 4 times, but the financials I'm looking at are as of 12/31/19. I have a feeling it's going to be a totally different story at 12/31/20. Debt of 86%, which isn't too great. Now, really the best way to look at ratios is to compare them to similar companies. And I have a lot of companies to compare them to. So Bloomin is right here. If you see a number in green, that means their ratio is better than the average company in their industry. And if it's in red, it's worse than the average company in the industry. I'm also highlighting the company that performed the best in that particular ratio. So Denny's has the best PE because it's in orange of 5.1. Bloomin is better than average. They have 6.8. The average in the market is 22. So certain companies have really high PEs, like Chipotle's through the roof at 84. Wendy's is a little better at 35, but still pretty high. And price to sales ratio, the average is 2.3, but Bloomin has the best at 0.2. The average price to book is 1.1. Bloomin is 5.2, much worse than the average. MTY, a Canadian company, is the best at 0.9. Current ratio, Bloomin is really struggling at 0.4. So is Cheesecake Factory and Denny's and Darden. Darden owns Olive Garden and a bunch of other restaurants. Dave & Buster's is the worst in current ratio at 0.3. ROE, Bloomin is the best at 77%. Denny's is negative 85% because they have negative earnings. And then in debt, Denny's and Starbucks are 100% debt. They have zero equity in their capital structure. So in terms of market cap, Bloomin is lower than the average. McDonald's is almost as big as all the other companies combined. Starbucks is pretty big as well, but the others are tiny next to giants like McDonald's. Bloomin is less than $1 billion in market cap. So let me know what you think of the video. I hope it makes it more interesting to look at all the other fast food and large restaurant chains. Thanks for watching. Leave a comment.